So before we get started in our notes, let's go over the 4 different things that would affect our owner's equity account. And remember, our owner's equity is also called capital. Capital is the account that involves owner's equity. So the first thing is an investment. Anytime we have an investment, that's going to increase our owner's equity. Also, revenue or sales would increase our owner's equity as well. And then the 2 things that decrease owner's equity were expense and withdrawal. So today we're going to be putting all of these transactions into T accounts that affect the accounts that would increase or decrease owner's equity. So go ahead and turn to your notes for lesson 2-3. You should also be on page 43 in your textbook. Okay, so on January 10th, we received cash from sales. So always start with cash because it's the easiest to work with. So I need one T account for cash, and then another T account for sales. Remember that sales increases my owner's equity. And then I'm going to go ahead and draw a line to separate the left side from the right side of my accounting equation. Let's go over that one more time just to be sure we have it down. Assets is on the left, the equals liabilities plus owner's equity on the right. So if the business received cash from sales, that means that Michael Delgado must have made a website and sold it to his customer, and then the customer paid him in cash. So he got $1,100 in cash. And remember that cash always increases as a debit because it's on the left side of the accounting equation. So I would debit cash for $1,100. And since we increased one side of the accounting equation, we need to increase the other side. So my sales would increase as well. And what would sales increase as, a debit or a credit? It should increase as a credit because it's on the right side of the accounting equation. So I can check myself. I've got one debit and one credit, both for $1,100, so my equation's in balance. Moving on to the next example. On January 12th, we sold services on account to Main Street Services for $500. So Michael Delgado sold a website to a customer, but they couldn't pay in cash. They wanted to charge it. So instead of cash, our asset would be accounts receivable. And it's accounts receivable because the business is going to receive the money at a later date. And then we would put dash Main Street Services to keep up with who owes us that money. I'm just going to abbreviate. But we still sold services, so that's still a sell. Anytime you see the word sold or the words sold services, that means sell. So I'm going to record that in the owner's equity account for sales. And since accounts receivable is an asset, it's going to increase as a debit. So we're charging Main Street Services $500. And then I need to increase my sales for $500 as well. So both my debit equals my credit, so I'm in balance. Okay, example 8. On January 12th, we paid cash for communications bill for cell phone and internet service. Since the business paid cash for a bill, let's start off with cash. Like I said, that's always the easiest thing to start off with if it affects cash. And here's my line to separate the left side from the right side. And then we have to figure out what the other account is. Since the business paid cash for a bill, okay, they paid for a cell phone and internet service. Anytime a business pays for a bill, that's going to be an expense. And this expense would be a communication expense since it was for cell phone and internet service. All right, now we need to figure out what we debit and what we credit. So if the business paid cash for a bill, since they paid cash, their cash is decreasing. And cash always decreases as a credit. So we would take out $80 in cash. And the expense is decreasing my owner's equity. So remember that owner's equity increases as a credit. So if I need to decrease owner's equity, I would debit it for $80. Expenses are always going to be debits because they decrease owner's equity. And now we can check it. I've got a debit for 80 and a credit for 80, so my equation would be in balance. Remember, you always need a debit and a credit of the same amount. Two more examples. On January 16th, we received cash on account from Main Street Services for $200. So Main Street Services is paying $200 of what they owe us. So this would affect my cash account and then accounts receivable for Main Street Services. I'm just going to write Main Street. So this is another example of when we have two transactions that affect the same side of the accounting equation. They're both assets. So if we received cash, the business received cash, then cash is going to increase by $200. So we would debit it for $200. And then Main Street Services is paying off $200 of what they owed us. So if they owed us $200, we need to take that off, so we would be decreasing that asset by $200. And so I have a debit and a credit for both $200. Last example, Michael Delgado withdrew equity in the form of cash. So Michael is taking money out of the business for his own personal use. So since he's taking money out of the business cash would be decreasing. And then we would also be decreasing owner's equity. So instead of writing owner's equity, anytime we have a withdrawal, that comes out of the account called drawing. So drawing is an owner's equity account, and it records any withdrawals that come out of capital. If you want to flip back to your accounts or chart of accounts page, you'll see drawing right under capital. Okay, and then here's my line to separate my left side from my right side. So cash is an asset, and if Michael Delgado withdrew cash from the business, that means he's taking cash out of the business. So we would credit cash because it would be decreasing for $350. And our capital would also be decreasing because he's taking money out of the business. So I need to decrease owner's equity, which means I would debit drawing. Remember, if you want to put, here, let me finish this first. So we would decrease owner's equity for $350. So I get a debit and a credit of $350. And then out here to the side of drawing, just make a note that this is any time you have a withdrawal, you're going to use the drawing account. So anytime you withdraw something, you're going to use the drawing account to record that. All right, go ahead and get out your work togethers. And actually, before we get started with the work together, go ahead and flip back a page or two to the chart of accounts. Let's finish recording what these counts are as debits and credits. So we talked about that debits, or the assets were all debits because assets are on the left side of the accounting equation. Accounts payable was a credit because it's on the right side of the accounting equation along with capital. But today we talked about what drawing was. Drawing is whenever you withdraw money from your equity. And so since it's decreasing owner's equity, that would be a debit. Then over here on the right side, we have revenue, which is sales. That increases owner's equity, so we would credit every sale. And then expenses decrease owner's equity, so those all would be debits. And then down here, if you have any more room, I know we already talked about it at the beginning, but let's go ahead and go over it one more time. So here's owner's equity. And let's list out what those four things do in terms of debiting or credit owner's equity. So anytime I have an investment that's going to increase my equity, so that would be a credit because I'm increasing my equity. Same thing with revenue or sales. I would be increasing my owner's equity, so I would credit it. So if you can remember that all sales are credits, that's going to help you later on. Also, expenses are always debits because they always decrease owner's equity. And same thing with drawing. Drawing always decreases owner's equity, so it's always going to be a debit. Okay, now let's go to your work together. Go ahead and turn to page 49 in your textbook so you can follow along with these examples. We're still working with Jensen Cleaning Service, and here's a list of these transactions. So on March 11th, we sold services on account to Johans Erickson for $125. So remember the two key words, sold services means sales. So we're going to write sales as one account. And Johans Erickson could not pay in cash, so they had to charge it. So we know we're eventually going to be receiving this money, and we're going to charge Johans Erickson for that sale. My sales would be increasing, so I would credit sales. Remember, sales are always going to be credits because they increase owner's equity. And then I'm also going to increase accounts receivable because I'm charging that to Johans Erickson's account to show that they now owe us $125. All right, so I've got a debit for $125 and a credit for $125, so we're in balance. Moving on to March 13th. Received cash from sales. So cash is going to be affected and sales. If the business received cash, that means cash is increasing. So we would debit cash for $260. And remember, sales is always a credit, so I would credit sales for $260 to show that it increased as well. Now I've got a debit and a credit for the same amount, so I would be in balance. March 14th, paid cash for telephone bill. So once again, cash is affected, and then telephone bill is going to be under what's called utilities expense. We paid, or the business paid, $54 for their telephone bill. So cash is decreasing, so I would credit cash for $54. And I would also need to decrease my equity. And remember, expenses are always debits, so I would debit utilities expense for $54. Last two. On March 16th, received cash on account from Johannes Eriksson. So once again, cash is affected. And then our accounts receivable for Johannes Eriksson would be affected because they're paying off part of what they owe. So we're receiving cash, so it would increase. So would I debit or credit cash if it's an increase? I would debit it. So I'm going to debit it for $125. And then I need to decrease my accounts receivable because I'm taking off $125 of what Johannes Eriksson owes. Last transaction. Paid cash to owner for a withdrawal. So cash is affected, and then remember, anytime you see the word withdrawal, that always means drawing. So the owner is withdrawing money out of the business, so our cash should be decreasing. So I would credit it. And then my owner's equity would also be decreasing as well. And drawing always debits my owner's equity. So I would debit drawing for $200. And as you can see, I've got a debit and a credit again that are in balance. And that's it for the notes. So y'all can go ahead and start on your application problem. Have a great day.